Surya, a lot of young people, especially first-timers who write into us, the sense you get from their portfolio. I mean, the good news is that a lot of young people are beginning to invest.
Yeah, that's true.
And we get a lot of mails coming in from 22-year-olds, 23-year-olds, 24-year-olds, first salary, I've started my SIP, and that's fantastic if you're on that path. But I think one of the things that troubles me is that it's almost entirely in equity. And maybe it's because equity is more,
The go-to thing.
seen as, the go-to thing and, more exciting, and people tend to want to believe that investing means equity. But there are, when you talk of asset allocation, even if you are at, say, 23, 24, 25, to tide over this kind of, volatility that you're going to see or a fall you're going to see in one particular asset class, it's probably good to also keep some money. May not be too much if you're young, but some money also in debt.
I totally endorse what you say, Vivek. And within that also there is another views which are coming across. I think for the younger generation this is true, which is that when you talk about returns on any asset class, you talk about equity, you talk about it giving you return of something of a 12-13% kind of a return on equity asset class over a long period of time. Short term it can be very high, can be very low also. So when these kind of returns are mentioned to the younger generation of today's time, they don't feel very good about it, because in their mind the expectations of an equity asset class is multifold. They believe that equity can deliver you returns which are 3x, 4x of your principal and in a very short span of time. Now this may be true, but this will not be true permanently for you. You will have those patches of investments which can turn around and give you this 2x, 3x, whatever it may be. But on an average, the returns delivered to you will be something close to what your inflation and GDP combination is, which I have already spoken about this earlier. So on an average, around 12-13% is the return which we should target. But the key is you don't compare that return with a 3x return, because then you really get disillusioned. And this return is actually very good return to look at if you actually do a compounding effect to it over a long period of time. That's what is important. Don't get concerned about a 12-13% return while your aim was 20-30%, because to achieve that kind of return, you'll unnecessarily take very high risk, which will even put your principal at risk, and your own risk appetite will not match it. Returns, everyone wants to get the maximum, not even optimization, the maximum returns. But in achieving that, you have to make sure that you are able to create that structure, that allocation in the portfolio, which is very, very critical for you.
Thanks very much, Surya, for your
Vivek.
inputs. And thank you all very much for being very good viewers all through this year in supporting us in our cause of making every Indian financially literate. We will keep bringing you many more videos around content which is devoted to financial literacy in this coming year. Wish you a very happy Diwali once again.
Wish you a very happy Diwali, everyone.